Alibaba stock has fallen 2/3 from the peak it set back in 2020. At the current price, the company has a valuation of $245 billion. It's got $31.2 billion of cash on the balance sheet, plus $39 billion of short-term investments. It's also got $22 billion of long-term debt, so the enterprise value is roughly $192 billion. Revenue over the last 12 months is $124 billion, with $11.6 billion of net income, $23.5 billion of adjusted EBITDA, and $26 billion of free cash flow. So right now, Alibaba is valued at 21 times earnings, 8.1 times EBITDA, and 7.3 times free cash flow. It's important to note that Alibaba's net income is skewed by large adjustments from stock-based compensation as well as changes in the group's equity investments. In fact, Alibaba has another $62 billion of investments on its balance sheet, which means the true valuation of Alibaba is potentially even lower. So at 7.3 times free cash flow, Alibaba stock looks incredibly cheap. That multiple indicates a company with zero growth ahead, but the latest earnings report paints a much different picture. Total revenue was up 14% year over year to $33 billion. Adjusted EBITDA increased 32% and free cash flow increased by over 70%. After a series of cost cuts last year, profit margins improved across all of Alibaba's segments except e-commerce, which was broadly flat. And management said that daily average users on the Taobao app have increased by 6% or more every month since April. So why is Alibaba stock so cheap? There are quite a few reasons. First, the Chinese economy has been going through a rough patch, first after COVID and now with youth unemployment and a housing bust. Second, the Chinese government has taken a heavy hand against large tech companies, imposing large fines for monopolistic practices. Third, trade tensions with the US raised the risk of delisting, where Alibaba stock would no longer be allowed to trade on US exchanges. All these risks are real, but a lot is also priced in. The Chinese government has tools to improve economic conditions, and Alibaba seems to be making some progress here despite the interference of government. Alibaba plans to split up its business into 6 smaller segments, which provides a potential catalyst and should help it avoid the wrath of regulators. Charlie Munger, David Tepper and Dan Loeb still all own big positions in the stock. So while Alibaba stock is certainly not without risk, a valuation of 7 times free cash flow provides a significant amount of downside protection. Alibaba may not warrant the same valuation multiple as a US company like Amazon, but Alibaba's multiple only needs to increase to say 12 times free cash flow to generate a 60% return on investment. And there's a chance that Alibaba stock is finally ready to move higher. That's why I currently rate the stock a strong buy, but these are my personal opinions and I do hold some shares in Alibaba stock. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.